Mortgage industry of the United States. The mortgage industry of the United States is a major financial sector. The federal government created several programs or government sponsored entities to foster mortgage lending, construction, and encourage home ownership. These programs include the Government National Mortgage Association, known as Ginnie Mae, the Federal National Mortgage Association, known as Fannie Mae, and the Federal Home Loan Mortgage Corporation, known as Freddie Mac. The subprime mortgage crisis was one of the first indicators of the 2007 to 2010 financial crisis, characterized by a rise in subprime mortgage delinquencies and foreclosures and the resulting decline of securities backing said mortgages. The earlier savings and loan crisis of the 1980s and 1990s and the national mortgage crisis of the 1930s also arose primarily from unsound mortgage lending. The mortgage crisis has led to a rise in foreclosures, leading to the 2010 United States foreclosure crisis. Mortgage lenders. Mortgage lending is a major sector of finance in the United States, and many of the guidelines that loan must meet are suited to satisfy investor and mortgage insurers. Mortgages are debt securities and can be conveyed and assigned freely to other holders. In the US, the federal government created several programs or government sponsored entities to foster mortgage lending, construction, and encourage home ownership. These programs include the Government National Mortgage Association, known as Ginnie Mae, the Federal National Mortgage Association, known as Fannie Mae, and the Federal Home Loan Mortgage Corporation, known as Freddie Mac. These programs work by offering a guarantee on the mortgage payment of certain conforming loans. These loans are then securitized and issued at a slightly lower interest rate to investors and are known as mortgage-backed securities (MBS). After securitization, these are sometimes called agency paper or agency bonds. Whether or not a loan is conforming depends on the size and set of guidelines which are implemented in an automated underwriting system. Non-conforming mortgage loans which cannot be sold to Fannie or Freddie are either jumbo or subprime and can also be packaged into mortgage-backed securities. Some companies called correspondent lenders sell all or most of their closed loans to these investors, accepting some risk for issuing them. They often offer niche loans at higher prices that the investor does not wish to originate. Securitization allows the banks to quickly relent the money to other borrowers, including in the form of mortgages, and thereby to create more mortgages than the bank could with the amount they have on deposit. This in turn allows the public to use these mortgages to purchase homes, something the government wishes to encourage. Investors in conforming loans, meanwhile, gain low-risk income at a higher interest rate, essentially the mortgage rate minus the cuts of the bank and GSE. Then they could gain from most other bonds. Securitization has grown rapidly in the last 10 years as a result of the wider dissemination of technology in the mortgage lending world. For borrowers with superior credit, government loans, and ideal profiles, this securitization keeps rates almost artificially low, since the pools of funds used to create new loans can be refreshed more quickly than in years past, allowing for more rapid outflow of capital from investors to borrowers without as many personal business ties as in the past. Origination. In the US, the process by which a mortgage is secured by a borrower is called origination. This involves the borrower submitting a loan application and documentation related to his/her financial history and or credit history to the underwriter, which is typically a bank. Sometimes a third party is involved, such as a mortgage broker. This entity takes the borrower's information and reviews a number of lenders, selecting the ones that will best meet the needs of the consumers. Origination is regulated by laws including the Truth in Lending Act and Real Estate Settlement Procedures Act 1974. Credit scores are often used, and these must comply with the Fair Credit Reporting Act. Additionally, various state laws may apply. Underwriter receive the application and determine whether the loan can be accepted. If the underwriter is not satisfied with the documentation provided by the borrower, additional documentation and condition may be imposed, called stipulations. Documentation and credit history can be used to categorize loans into high quality A paper, ALTA, and subprime. Loans may be also categorized by whether there is full documentation, alternative documentation, or little to no documentation, with the economic stream, no income, no job, no asset loans, referred to as NINJA loans. No-doc loans were popular in the early 2000 years but were largely phased out following the subprime mortgage crisis. Low-doc loans carry a higher interest rate and were theoretically available only to borrowers with excellent credit and additional income that may be hard to document. Example: self-employment income. As of July 2010, no-doc loans were reportedly still being offered but more selectively and with high down payment requirements. Example: 40%. The following documents are typically required for traditional underwriter review. Over the past several years, use of automated underwriting statistical models has reduced the amount of documentation required from many borrowers. Such automated underwriting engines include Freddie Mac's Loan Product Advisor, FKA Loan Prospector, and Fannie Mae Desktop Underwriter for borrowers who have excellent credit and very acceptable debt position. There may be virtually no documentation of income or asset required at all. Many of these documents are also not required for no-doc and low-doc loans. Credit Report 1003 Uniform Residential Loan Application 1004 Uniform Residential Appraisal Report 1005 Verification of Employment 1006 Verification of Deposit 1007 Single Family Comparable Rent Schedule 1008 Transmittal Summary Copy of Deed of Current Home Federal Income Tax Record for last 2 years, verification of mortgage payment, verification of payment VOP, borrower's authorization, purchase sale agreement 1084A and 1084B, self-employed income analysis, and 1088 comparative income analysis used if borrower is self-employed.